Good morning. Welcome to Kenya News Update today. I'm your host, and we're beginning with a major corporate story that's generating significant buzz in Nairobi's financial circles. Kenya Power and Lighting Company, the nation's electricity distributor, has just announced a surprisingly robust half-year profit. The headline figure is a profit after tax of 10.4 shillings billion for the 6 months ending December 31, 2025. This strong performance has prompted the board to declare an interim dividend of 0.3 shillings per share, a move that will directly benefit shareholders. But this story is about much more than just a single financial report. It's a complex narrative about a state-owned enterprise navigating a challenging economic landscape, questions about energy security, and the broader geopolitical currents that affect everything from power grids to national budgets. Over the next 12 minutes, we'll dive deep into the numbers, explore the contrasting perspectives on what this profit truly means, and examine the external pressures that could shape Kenya Power's future. We'll hear arguments that this is a sign of a successful turnaround, and counter-arguments that question the sustainability and social equity of these earnings. Let's begin by unpacking the core financial results that have everyone talking. A profit of 10.4 shillings billion is a substantial figure. To put it in context, we need to look at the company's revenue streams. According to the report, total revenue for the period grew to 114.87 shillings billion, up from 107.42 shillings billion in the same period the previous year. That's a significant increase. On the other side of the ledger, operating expenses were reported at 25.16 shillings billion. Now, the critical number that often gets debated is the finance cost, which is the money spent on servicing debt. For this half year, finance costs stood at 23.74 shillings billion. This is a crucial point of analysis. A large portion of Kenya Power's expenses goes towards paying interest on its substantial debt, which is a legacy of past infrastructure investments and procurement challenges. So, the profit of 10.4 shillings billion emerges after accounting for this massive finance cost. The company also reported other income of 1.43 shillings billion and a tax expense of 492 shillings million. The declared interim dividend of 0.3 shillings per share represents a payout from this profit. Management has attributed the improved performance to what they call enhanced system efficiency and a growth in electricity sales. They point to strategic initiatives aimed at reducing technical and commercial losses. That's the electricity that is either lost in the grid or goes unbilled. But is the story as straightforward as a well-managed company posting good results? Let's introduce our first perspective. Proponents of the current management and government policy see this as a clear victory. Analyst Michael Camo, speaking from Nairobi, argues this is evidence that the reforms initiated over the past few years are finally bearing fruit. He points to the government's last-mile connectivity program, which has aimed to hook up more households to the grid. More connections, in theory, mean more customers and more revenue. Camo also highlights the crackdown on illegal connections and improved billing systems as key drivers. From this viewpoint, the profit validates the tough decisions made, including past tariff adjustments that were often unpopular with the public. The dividend, they argue, is a rightful reward to shareholders, the largest of which is the Kenyan government itself, and it signals confidence in the company's future. It's a narrative of a struggling giant getting back on its feet through better management and strategic focus. However, this perspective is met with immediate and forceful counter-arguments. Consumer rights advocate and economist, Dr. Aisha Mwenda, offers a starkly different interpretation. She doesn't dispute the numbers but fiercely contests what they represent. Her central argument is that this profit is not built on innovation or exceptional service delivery, but on the back of overburdened Kenyan consumers and businesses. She points to the series of tariff increases approved by the Energy and Petroleum Regulatory Authority, EPRA. Dr. Mwenda argues that in a period of high inflation and economic strain, these increased costs for electricity have directly fed into the company's top-line revenue, creating a profit that feels more like a transfer from household budgets to a corporate balance sheet. She questions the quality of service, citing ongoing complaints about unreliable supply, frequent outages in some regions, and slow response times to faults. For her, a profitable Kenya Power that still delivers poor service is a policy failure, not a success. The profit, in this view, is a symptom of a monopolistic structure where consumers have no alternative, rather than a sign of competitive excellence. This debate takes on an even sharper edge when we consider the global context of energy security. While Kenya Power announces its profits, News wires are carrying stories of mass power outages in Ukraine following what's described as a technical malfunction. This is a chilling reminder of how vulnerable national grids can be, not just to technical faults, but to targeted attacks in times of conflict. For Kenya, the question isn't about war, but about resilience. Does a profitable Kenya power translate into a more robust and reliable national grid? Can it invest these profits into hardening infrastructure against climate-induced disruptions, like droughts affecting hydropower or storms damaging transmission lines? This is where the second layer of debate emerges. Some experts argue that every shilling of profit should be relentlessly reinvested into modernizing the aging grid, adopting smart technologies, and diversifying the energy mix to include more renewable and stable sources. They see the dividend payout as a potential diversion of crucial capital. Others counter that a company that cannot generate returns for its investors will never be able to attract the large-scale capital investment needed for such massive upgrades in the first place. The dividend, they say, is a signal of financial health that makes future fundraising easier. Now, let's zoom out further to the intricate web of international relations and how they touch a company like Kenya Power. Two seemingly unrelated stories highlight this connection. First, the ongoing reports of African men, including Kenyans, being allegedly tricked into fighting for Russia in the Ukraine conflict. Second, the recent approval by the United States, under President Donald Trump, for billions in arms sales to Israel and Saudi Arabia. What do these have to do with Kenya's power company? They speak to the volatility of the global order. Geopolitical tensions, from Eastern Europe to the Middle East, have a direct impact on global energy markets. They affect the price of fossil fuels, which Kenya still relies on for thermal power generation. They affect the cost and availability of equipment and technology needed for power projects. They even affect the flow of international development funding and loans that often support energy infrastructure in countries like Kenya. Kenya Power's debt, much of which is denominated in foreign currency, becomes more expensive to service if the Kenyan shilling weakens due to global risk aversion. Furthermore, Kenya's own foreign policy stance, under President William Ruto, navigating relationships with Western powers, China, and other African nations, can influence investment partnerships in the energy sector. A profitable Kenya Power might be seen as a more attractive partner for foreign investors or technology firms, but it also operates in a landscape shaped by these larger, often unpredictable forces. Returning to the financials, let's examine the dividend decision more closely. The interim dividend of 0.3 shillings per share is a concrete action. For the government, which holds a significant stake, this means a direct cash injection. In a time of fiscal constraints, that revenue is welcome. For private shareholders, including pension funds that hold Kengen stock for millions of Kenyans, it's a return on investment. But critics ask, at what opportunity cost? Could that money have been used to accelerate the prepayment meter rollout to improve revenue collection further? Could it have funded a pilot project for battery storage to stabilize solar and wind power integration? The choice to distribute profits versus reinvest them is at the heart of corporate strategy and public interest for a state-owned enterprise. This brings us to the historical context. Kenya Power has had a checkered financial history. There have been years of significant losses, controversies over expensive power purchase agreements with independent producers, and allegations of mismanagement. The current profit must be viewed against this backdrop. Is this the beginning of a new, sustainable era of profitability? Or is it a cyclical peak driven by temporary factors like favorable hydrology for cheap hydropower or a one-off reduction in system losses? The half-year report suggests a 5.5% growth in electricity sales. Is that growth rate sustainable as the economy faces headwinds? Will industrial and commercial customers, the biggest revenue contributors, maintain or increase their consumption? These are open questions that the optimistic and skeptical camps answer very differently. Let's now consider the technological frontier. The global energy sector is undergoing a radical transformation driven by decentralization and digitization. Rooftop solar, mini-grids, and home battery systems are becoming more affordable. This presents both a threat and an opportunity for a traditional utility like Kenya Power. The threat is grid defection, where large consumers or even residential estates generate their own power and reduce reliance on the national grid, eroding the utility's customer base and revenue. The opportunity lies in Kenya Power evolving from a simple bulk electricity seller to a manager of a complex, two-way grid, where it can balance supply and demand, and even purchase excess solar power from homes. The profits reported today could fund the research and pilot projects needed for this transition. Or they could create complacency, leaving the company vulnerable to disruptive new entrants in the energy market. This technological dimension adds another layer to our debate. Is Kenya Power's management thinking strategically about this decentralized future, or are they focused on optimizing the old centralized model? The company's investments in grid automation and data analytics might provide clues. Finally, we must address the social contract. Electricity is not just a commodity, it's a fundamental enabler of economic development, education, and healthcare. The government's own development agenda, including digital transformation, relies on ubiquitous, affordable, and reliable power. Therefore, Kenya Power's performance is a matter of national interest, not just shareholder interest. Balance between commercial viability and public service is delicate. Tariffs must be high enough to sustain the company, but low enough to not stifle economic activity or overburden the poor. The profit announcement will inevitably lead to calls from consumer groups for tariff reviews, or for the profits to be used to subsidize connections for low-income households. The government, as both regulator through EPRA and majority shareholder, finds itself in a potentially conflicted position. It wants the company to be financially healthy, but it also faces political pressure to keep electricity costs down. This is the ultimate tension in the story of Kenya Power's 10.4 shillings billion profit. In conclusion, the numbers are clear: 10.4 shillings billion in profit, 114.87 shillings billion in revenue, and a 0.3 shillings per share dividend. But the meaning of those numbers is deeply contested. For some, it's a triumph of reform and a sign of a utility turning the corner. For others, it's evidence of a monopoly extracting value from a captive market without corresponding improvements in service. When viewed through the lenses of global energy security, geopolitical shifts, technological disruption, and social equity, the story becomes a multifaceted case study in modern nation building. Kenya's journey towards universal, reliable, and clean electricity is intertwined with the fortunes of this company. The half-year profit is a significant data point, but it is not the end of the story. The coming months will reveal whether this profitability is a foundation for future investment and innovation, or a peak before new challenges emerge. The debate between commercial success and public service will continue, and Kenya Power will remain at the center of it, literally keeping the lights on while navigating an incredibly complex landscape. For Kenya News Update today, this has been a deep dive into the currents powering our nation. Subscribe to Kenya News Update today for more in-depth analysis.